In today's video, I'm going to teach you how to trade gold using a strategic approach. Whether you're a beginner or looking to refine your skills, understanding the steps involved in navigating the gold market is essential. Let's dive right in and explore the process from start to finish. First, it's essential to choose the type of analysis you'll use. This decision will shape your entire view of the market. If you opt for technical analysis, you'll rely heavily on patterns, statistical data, and various technical indicators to make informed trading decisions. On the other hand, fundamental analysis is all about the factors driving gold prices, such as economic conditions, news events, and geopolitical issues. Some traders prefer a combination of both methods, allowing them to apply techniques from each to maximize their trading potential. For today's example, we'll focus solely on a technical approach. Next, you'll need to specify the area of your analysis. Both technical and fundamental analyses are complex and multifaceted, so it's crucial to choose specific concepts and techniques that align with your trading goals. With a technical approach, you might delve into harmonic patterns or combine key levels with technical indicators. If you're leaning towards fundamental strategies, your focus might be on trading the economic calendar or significant news releases. In our case, we'll zero in on support and resistance levels, as well as smart money concepts. Selecting your trading time frame is the next step. It will define the style of your trades. Focusing on a shorter time frame, like hourly, allows you to capture intraday movements, while a daily time frame is more suited for identifying longer swing movements. You might also consider combining multiple time frames for a more comprehensive view. For this strategy, we'll be using both daily and hourly time frames. Defining your trading zones is a critical part of the process. A trading zone is essentially an area or level on a price chart where you look for potential trading opportunities. For instance, technical traders might use moving averages as key points to watch. In today's example, we'll be using support and resistance levels on a daily time frame as our primary trading areas. Choosing confirmations for your trades is another vital step. A confirmation acts as your entry signal, consisting of conditions that suggest a likely outcome. For someone trading on economic calendars, an increase in CPI figures could be a reason to go long on gold. Here, our confirmation will be a local change of character observed on an hourly time frame. Now let's define stop loss placement, entry, target selection, and the desired reward to risk ratio. It's crucial to pinpoint where your entry should be, where the stop loss will lie, and where you aim to set your target. In our case, we plan to open a position immediately after a confirmed change of character, placing the stop loss below the lows for a buy or above the highs for a sell. Our target will be the next daily structure with a minimum reward to risk ratio of 1.5. Understanding your risk is another key factor, so define your lot size and risk per trade. Have clear rules for calculating the lot size for each trade. In our example, we will risk a strict 1% of our trading deposit per trade. Once the trade is active, trade management rules will dictate your actions. Options include waiting for your take profit, or TP, or stop loss, SL, to be hit, or employing a trailing stop loss. For our strategy, we'll move the stop loss to entry 10 minutes ahead of the release of significant U.S. news events as seen in the economic calendar. Before implementing your strategy, backtest it thoroughly. Dive into historical data, backtest at least 50 trading setups that align with your criteria, and ensure the strategy yields a positive win rate. Finally, test your strategy on a demo account for at least a month. During this period, aim to achieve positive overall results. Consistent profits on a demo account will signal that your strategy is ready for real trading. If the results aren't as expected, consider tweaking your conditions, backtesting again, or even developing a new strategy altogether. Trust the process, and you'll be set for success in the gold trading market.